Welcome to the Markets Happy Hour podcast, a weekly markets update for investors the world over. Each week we discuss inflation, geopolitics, interest rates, equity markets, and other asset classes. To try to answer the question, what does this mean for my investment portfolio? Let's dive in.
This has been a recent theme over, say, the last few weeks here around stagflation and the potential for this to lead to stagnation. We've already seen that that flag been raised in the UK for some time. Inflation, if we're talking about higher expectation 26, I think maybe this uncertainty could inject some stagnation. We do have more slides later about what is underpinning the US economy in particular, why it's been resilient. But if you think about stagflation, even if it's temporary, how would you insulate portfolios from that? And do you think about that in a kind of broader context?
It's a great question, and I don't think there are that many options. I would say from a portfolio construction point of view, it's probably the regime that is the most challenging to position for. And we have had just a sense of that again in March. It was a sort of a deja vu of 2022. Say most portfolios, and if you think of the market portfolio in terms of market capitalization of what represents, which asset classes represent most of what people own, one way or another, is bonds and equities. So when bonds and equities fall together, you have a problem, right? Most people would have a problem. Whether it's a 60-40, 40-60, 80-20, basically you suffer, right? And the reason behind that is inflation, because if inflation moves up more than expected and by enough to change expectations around interest rates and create enough of a surprise, which is exactly what has happened now and sort of what happened in 2022 in a different context for a different reason, but the dynamics were similar, then obviously both assets, both equities and bonds reprice lower. So what can you do for that? I mean, if it is transitory, I think there is not a lot to do, because typically if we were to say, okay, this conflict is resolved tomorrow, flow of oil normalizes, which is a big if, but let's assume it does. Historically, geopolitical conflicts tend to basically not be too impactful on market performance. Markets recover pretty quickly, and you would expect the oil price in that case to correct back to, say, $80, give or take, 70 to 90, but call it 80. Equities recover, and basically the position, the confluence of factors that you had before the conflict was constructive enough, right? So you would want to still be engaged in risk, and you would still expect equities to do well. You would expect bonds to recover, in that case, from basically the moves high in rates. Rate is tight, but we'll do okay. But that's one scenario. Yes, the other scenario is very different, right? Like, what do you do outside of bonds and equities? And basically, commodities is not the easiest of exposures to have for access reasons or for rolling cost reasons, but it's one that makes sense. There are some commodities, whether it's gold, whether it's copper, where you have structural demand stories, where you have an angle to say it helps diversify portfolios and helps preserve value in a potentially stagflationary environment. Then it's exposures to energy, and probably I would say that is through mostly equities rather than directly owning oil, or basically buying oil as a financial asset. And we have seen expectations obviously move higher, being revised upwards for energy companies, as you would normally do. But that's a small sector in the context of the equity market, right? And then you can obviously try to manage your duration exposure, lower duration, basically floating short duration, high quality credits. So it's a move up in quality, it's a move towards shorter duration, it's a move towards safe haven currencies. The US dollar, we can debate whether the US dollar is safe haven, but I think going back to the US dollar, and again, this goes very much against the prevailing consensus coming into this year and into the conflict, but potentially diversifying with Swiss francs. But there is not a huge degree of options. I mean, I think if you have access to private markets, infrastructure is one that makes a lot of sense, because of the link to inflation pricing, because of some of the tailwinds structural that infrastructure allows you to play. But it's a very different portfolio. It's not a portfolio you can then unwind very quickly and reposition. So it's sort of like the K economy, but in portfolio construction land. So I think it's difficult. And I don't think people are basically taking all into one, all into the other. So there is a lot of wait and see and managing at the edges, I suppose. And I think that makes sense.